Good morning, everybody. Welcome to your live virtual classes. And we are in the company accounts. We are doing the fourth session today. Yeah, fourth session today. So there's a little technical problem. So sorry for the first 10 minutes. We'll compensate it at the end of the class. No worries. Okay. So the last class, we have winded up with one particular and the most important concept which we were dealing with in the unit number 3, issue of debentures. So under the issue of debentures, we have discussed that it is similar to the issue of shares. And the concepts that we learned in the earlier chapter of issue of shares, the same concepts have been coming here. Apart from that, there are 2, 3 other new concepts that we have learned the other day. So a debenture can be issued for cash. Technically, you do that. But a debenture is different from the share with the only difference that a debenture is a kind of a loan. So when a company issues debentures, it is nothing but it is giving or it's taking a loan here from the public. And a debenture is like a fixed interest security wherein the percentage will be given and that interest will be paid irrespective of whether profit is made or not. That is why I use the word called as charge against the profits. So irrespective of you earning a profit or loss, the company is supposed to pay the interest as promised to the debenture holders. The debenture holders, the nature is they are more like creditors for that particular company. And when a person purchases the debentures of a company, he will be given a debenture certificate. And rather, what happens is a debenture trust will also be created, which will solely be responsible to take care of the interest of the debenture holders. With this theory, we went ahead and we saw the debentures can be issued for cash at par, premium, and discount. The only concept that was different from shares into debentures was the debentures can be issued at discount. When can the debentures be issued at discount? I told you when in the market there are other investment opportunities for the people which is offering a higher rate of interest. But the debentures that the company is giving you a lower rate of interest. So why will the people put money into your particular company in the form of debentures when they are getting a higher return? So that is why we discussed the concept of a debentures can be issued even at a discount also. Correct? So these were the 3 things. And I told you when the debentures are issued at premium or at discount, like in the way of shares, in the case of debentures also, in the particular respective installment, and I told you very clearly here, there will not be 2 to 3 installments, no, just application or allotment. In some cases, only application. Okay. So in such cases, either application or allotment, wherever the premium is collected or wherever the discount is being charged, you have to go to the transfer entry. And in the transfer entry, securities premium should be credited. Where you issue it at a discount, then the loss on the issue or discount on the issue of debentures is a loss for the company because you're not getting that amount of discount that has to be debited. So this was the first concept that we learned and we saw. The second concept I taught you was the debentures can be issued for a consideration other than cash. The main purpose of issuing a debenture is to get cash. I need money for running my business. I want cash. One of the ways I can issue the debentures. But if you are purchasing a plant and machinery or you're taking over assets from another company, but you don't have enough cash to pay them, in that case, you can issue the debentures also for consideration. What will happen is you are supposed to, in these kinds of problems, calculate the number of debentures for which I told you similar concept in shares also. And the amount to be calculated, the formula to be used is the value of the asset divided by the issue price. Why am I stressing about the issue price? Because issue price and the face value both are different concepts. I can issue a particular debenture at par, at premium, and at discount. So issue price is nothing but when issued at par, it will be face value is equal to face value or face value is equal to the issue price because both are same. I'm giving to them at the face value itself. So the issue price is that. If there is a premium in the question, then the issue price will be face value plus that premium. If there is a discount in the question, it will be issue price minus the discount. This is quite important. So why am I talking about issue prices? To find out the number of debentures. When you get a question of issue of debentures for consideration other than cash, the entries that you pass are 2. Asset account to the percentage debenture, asset account to the vendor account to the percentage debenture. When you are passing the second entry in the narration, very important, what you should write. How many number of debentures are issued at what price you should write. For that, this formula becomes important. So it will be the asset value divided by the issue price. Now, issue price can be in three different categories. Okay. That is how we found out. This was the second concept. The third concept that we learned the other day was issue of debentures as a collateral security. Whenever you're taking a loan from the bank, apart from giving the primary security, sometimes the bank might insist you to give additional security. In that case, your debentures, which is the instrument of the company, can be given as a collateral security. When you are giving the debentures to the bank as collateral security, there is no change effectively. Only when you don't pay the original bank loan and after the sale of the asset, still the bank loan is not repaid, for the remaining defaulting amount, the debentures will come into the picture. So, my dear students, until and unless the final loan is not repaid, technically there is no debentures being issued. So, that is why I told you for accounting of the debentures as a collateral security, you can have two ways or two methods. Under the method one, quite simple method, I don't do anything. In the balance sheet, I don't do anything. I don't pass any entries. Just simply in the notes to accounts, I just mention under that particular loan, collateral is secured by the issue of so many debentures. I just write. That's all. But under the method two, they pass an entry. This particular entry is quite simple, single entry. Debenture suspense account debit to percentage debenture. So the percentage debentures are your loan. So you will group it under the long-term borrowings, under the balance sheet, equity and liabilities. Debenture suspense should come onto the asset side. Which part of the asset? Other non-current asset. So under the non-current asset, it will come there. So this is the second way that you can do. But logically, your textbook asks you to follow the method one, which is not passing in any entry and then just writing it in the notes to accounts. That's as simple as that. Then we learned the next concept of interest on debentures. How will you calculate the interest on debentures? What are the entries to be passed? Two entries to be passed, interest to be calculated on the face value. Irrespective of whether it is issued at par, premium and discount, it is not your problem. What is the rate? Where the rate will be given? Before the word debentures, the rate will be given. Take that rate, multiply with the face value. Madam, it is issued at premium. Not your problem, only face value. It is issued at discount. Don't worry, take the face value. Compute it for the entire year. The other day, Gauri was asking me, Madam, should I divide it by 2 or by 4? Why am I dividing it? Because the interest that you get in the first step is for the full year. Technically, the company has a habit of not paying the entire interest in one installment or in one go to the shareholders, but it will pay half yearly or it can pay quarterly. If half yearly, there are 2 half years, divide by 2. If it is paid in quarters, 4 quarters, divide by 4. Whatever amount you get, pass it in the form of entries. And whatever amount you get, there is a concept of TDS, tax deducted at source. 10% of that amount will not be given to the shareholders, but it will be given to the government. Okay? So what the entries will be? Interest account debit to the debenture holders, and it will be to the TDS. And when you make a payment, debenture holders account get debited and TDS gets debited and you are going to credit bank. So the technical thing is interest to bank, but you're dividing that. Why, madam, you're showing it in the liability in the credit side? I have collected that amount. I have taken it from my profits, kept it separately. The second entry is when I'm actually making the payment, I am paying a part to the debenture holders and one part is going to the government as TDS. As simple as this. We came back to the last concept, which was the loss on the issue of debentures. Only then I was talking about two things. So we were doing all the illustrations and we came to the illustration number 4 and 5, the last part we did. I would like to again talk on the same particular issue because this is one of the most, I can tell you this is the most important in debentures, okay? So when a debentures are being issued by the company, I told you can issue them at par, at premium and at discount. When you issue it at discount, it means that the face value of 100 is not received entirely. there is a discount that is being deducted. Let us say 5 rupees, and the company only receives 95. Why should a company go in for issuing the debentures at a discount? Again, I told you, to attract the people to invest into your debentures, you are offering them like a sale. Like there'll be offers in the shops that you can go and purchase the items for a lesser rate, 20% off, 30% off. The same thing here they're applying. So you will ask me, or you will understand that it is a loss to the company. So this is a loss. When the debentures are originally issued, if they are issued at a discount, it is a loss. Clear? Now come here. Madam, irrespective of issue, for the purpose or in the case of a debentures, always whatever questions you have read for debentures till now, there will be words talking about redemption. What is redemption? Redemption is nothing but repayment. Since it is a debt or it is like a loan, at the time of issue itself, the debenture holders should be given clarity as to when the debentures will be repaid. They should be given clarity as to when the debentures will be repaid. So they will say a company issued so and so debentures at so and so value, redeemable at the end of, redeemable after 5 years, redeemable equally but at the end of 3 years. So these points are important. The redemption terms will also tell after the period, and also it will say at what value. So the redemption can be done at par. That is, I take 100, I give you back 100. No problem. No accounting entry, no change, everything same. But if I tell I'm going to redeem at premium, you gave me 100 rupees. Who is this you? The debenture holders has given the company initially 100 rupees. Now the company is supposed to repay. That is the meaning of redemption. So who pays to whom in redemption? The company pays to the debenture holders back their money. Now, when I say the redemption is done at premium, the simple understanding is the company is telling, since till now you have invested in my company in the form of debentures, I did a very good work, I got so much good profits. So let me reward you, let me give you additionally. You gave me 100, I paid interest, everything, that is over. Now I am giving back your money of 100, but let me put 5 more rupees and give it to you. This premium that the company is supposed to pay to the debenture holders at the time of redemption is a loss. So, redemption premium means it is a loss to the company. Don't confuse with securities premium. All of you please remember, if the question says the debentures are issued at a premium, that means when the debentures are issued at a premium, that is securities premium. Debentures are issued at a premium, only that is securities premium. It is a profit because who pays here? The debenture holder pays to the company. That is this. When I'm issuing my debentures, the debenture holders are paying me excess money, which is the issue premium. That will be taken to the securities premium. But mind it, in the same question, after telling like this, they will also include the redemption term stating the debentures are redeemable after a period of 5 years at a premium. Redeemable at a premium is nothing but premium on redemption. What is that? It is premium on the redemption. So this and this are technically opposite. Even though the word premium is there, the nature is different. Here when you issue, premium is a profit to the company because you are receiving money, excess money. But when you talk about redemption premium, here you are supposed to give money. So what it will be called, or it will be taken to debenture redemption premium account. This is a loss to the company. It is what? It is a loss to the company. So the last case I still remember, when both of these losses are coming, you also have discount, you also have premium on redemption, both given in the question. Now what should I do, madam? Simple thing, go to the transfer entry of the particular installment where the discount is received. So in illustration number 5, we had two things. We had what? We had application, we had allotment. So in allotment, there was discount. So application, normal entries we passed close. In the allotment, when we came, what did we do? In the allotment, we passed two entries, transfer entry and receipt entry. In the transfer entry, can we all again see how we passed the entry? In the transfer entry, okay, in the transfer entry here, if you can see, it is debenture allotment account. I'll just pass and show you. Debenture allotment account to percentage debenture. Since this is originally issued at discount, there is a loss. So I told you take it on the debit side. So it is nothing but loss on issue of debentures. This is the original thing which we did. There was no doubt. But when this redemption also came into the question, I told you for the redemption premium alone, there will be two accounts. So parallelly, I will be crediting debenture redemption premium account. It is not securities premium, debenture redemption premium account. Okay. Now, madam, what should I debit? I told you, since already there is a debit account existing, in this itself add that amount. Which amount? The debenture redemption premium amount. Clear? So already on account of discount, you already opened a loss account. Loss account, what account? Loss on the issue of debentures. So since I've issued the debentures at a discount, that is one loss. When I'm repaying the debentures, I have promised I will give you at an extra value. That is also a loss. Both the losses together, I am putting it in the debit side. That's all. This was the concept that we saw the last class. Now, additional to that concept was, now I have calculated the total loss. So the loss can be either discount on the issue or it can be a redemption, premium on the redemption. So these two in a question, you can have either discount, then only discount will be the loss. Or in a question, you can have either only the premium on redemption, then it will be only this. In some questions like your illustration 5, you can have both. Then the loss will be the total of these two. That's all. Okay. In few questions, my dear, please understand there can be only discount or there can be only premium on redemption. In some questions, there can be both together. So if the question asks what is the loss, it should be both together if there is both in the question. If there is only one, that much only will be the loss. Now, I was telling you the other day, sorry, just a minute. Okay. So I was telling you the other day, this particular loss that you have calculated, is it a revenue loss? What is the meaning of revenue loss? If I talk about or I tell it is a revenue loss, it will be taken to the P&L the same year, right? But is this a revenue loss? Debentures are capital instruments. So any loss or any profit that I am getting on account of those debentures should also be a capital loss and capital profit only. If I am issuing the securities at a premium value, it will be taken to securities premium account, right? That is a capital profit. The same way, when I'm issuing it at a discount or I am redeeming at a premium, in both these cases, I get the loss. That will also be called as your capital loss only. So the meaning of capital loss is it will be shown in the balance sheet, like your preliminary expenses. Now, the point here is the act specifically says I can show it or I will show it in the balance sheet, the loss amount, but during the period, because debentures are usually issued as redeemable debentures, after a period, they'll be paid back. So by the time they are paid back, I am supposed to write off this loss to the P&L account. So after 3 years, if the debentures are going to get redeemed, after 3 years, in case I was having a capital loss in the form of discount or in the form of redemption of premium, in these 3 years itself, I should write off the amount. How am I supposed to write off the amount? That is the question. Okay. How am I supposed to write off the amount? That is the major question here. So, madam, as per the concepts taught by you, I have now computed what is the total loss on the issue of debentures, madam. So in my question, I can have either discount or I can have the redemption premium both put together. I got this value, madam. Now, how do I write off? Here also, there are two ways in which you can write off the premium or the loss. What are the two ways? The first one is called as equal installment. Okay. What is equal installment? If the question says the debentures are redeemable equally after a certain period, or let us say they are redeemable after 5 years. That's all. They use the word this. They say they are redeemable equally after 5 years. So now let us come here. Let us say discount comes to 6 rupees and redemption premium comes to 4 rupees. The total loss that I have already calculated in the question is 10 rupees. Okay. Now you people see when they are redeemable after 5 years equally, which means that every year the same amount will be written off. So what will be the formula? Can you think and see? Because till now we have done depreciation, till now we have done so many other concepts wherein the same concept is being used. The entire 10 rupees, which is the capital loss, will be divided equally over the 5 years. So each year I am going to write off what? 2 rupees. Each year I am going to write off 2 rupees. So at the end of the first year, it will be first year beginning will be 10 in the balance sheet loss. At the end of the first year, 10 minus 2. I would have removed 2 taken to P&L as my loss. It will become 8. Then 8 will become 6. 6 will become 4. 4 will become 2. And at the end of the fifth year, 2 minus 2 will become 0. So by the time we would have very much proportionately bought 2 rupees, 2, 2, 2, 2 into the P&L and it has been written off completely. As simple as this. The second can be they want to complicate our particular thinking and they will ask you every year a portion of it is redeemed. So let us take every year, maybe say 20% is redeemed. In this case, what you have to do, it is like in the depreciation, you have already done sum of the year digit method. Yes, you have already done sum of the year digit method. Correct? The same logic you are going to use here, wherein you are going to do and find out the ratio in which it will be written off. So always in this kind of not in equal installments, but different amounts are getting redeemed, what will happen is you should arrive at the ratio. Based on the ratio, you will be writing off this 10 rupees differently over the 5 years. If 5 years are given here also, but the word used is every year there is a different amount that is being repaid, not the same amount. Then you need to find this out. How to do this, I will tell you when we are doing the illustration 12. But for now, to you, understanding is there are two methods in which we can write off the loss. So the first step is calculation of the loss. How to calculate, madam? If there is a discount in the issue of debentures, that is a loss. And if there is a premium on redemption, that is a loss. Read the question, identify the loss. After identifying the first step, read the question further to understand if there is an equal installment or equally it is repaid after or during the period. If that is the case, simple. Whatever loss, divide by the number of years. Over. Every year, the same amount will be repaid. Okay. The second method can be not equal, madam, but only a portion is getting repaid. Then you need to remember from your depreciation concept, we have done sum of the year digit method. In the reverse, we write, correct? So we do like this 5, 4, 3, 2, 1. We take the addition, which is 15. So first year 5 divided by 15. That is 5 divided by 15. So the remaining number of years we used to add. A similar concept is followed here. Now with this background, I think we can go ahead with the questions. Now the question number or the illustration number 11. All of you please look onto the board. HDC issues 1,12% debentures of rupees 100 each at 94 on 1st of January. What is the meaning? So 1 lakh debentures are issued, face value is 100, but they are issued at a lesser value, which means that there is a discount of how much? 100 minus 94, 6 rupees per debenture. Okay, that is a loss. Under the terms of issue, I always told you in the issue terms itself, they will give you about the redemption terms also. Under the terms of issue, the debentures are redeemable at the end of 5 years from the date of the issue. So the word given here is redeemable at the end. Simply, they have just mentioned redeemable at the end of 5 years. Calculate the amount of discount to be written off in each year. So this much is the question given to you. So I told you the keyword is if they are telling you simply that the debentures are redeemable after a certain period directly, it means that it is equal installment. You don't even have to think. It is nothing but the equal installment method. So now the first step is calculate what is the amount of loss. Correct? So the first thing I told you is what is there here? The debentures are issued at a discount. Correct? They have mentioned redeemable at the end of 5 years, but did they tell are they redeeming it at a premium? The question is silent, which means that here in this question there is only discount given. On redemption, there are no terms mentioned. So it is assumed that there is no premium on redemption and only the discount. And how much is the discount? 1 lakh debentures into 100 rupees minus 94. Why, madam? Given to you in the question. 100 rupees face value. At 94, it is issued. So indirectly, 6 lakh rupees is the discount on the issue of debentures, which is the loss. So this is a capital loss. Now, the question also said it is redeemable after 5 years. The same thing. What is this? It is the same thing. Redeemable after 5 years. So, every year the same amount will be written off. Correct? So, the simple way to analyze is amount of the loss to be written off each year can be taken directly as 6 lakh divided by 5, 1,20,000 per year. So I can show it like this and complete the question. Okay, which is nothing but I have arrived at the loss, which is the discount value in this question. I am taking this 6 lakhs and then I have been given in the question after the period of 5 years, 6 lakh by 5, 1,20,000 per year. But my dear students, the textbook or the study material wants to prepare you for the second method by drawing a tabular column. So what they are doing is they are telling you, okay, this is very, very good, well, fine. If you do this also correct only. But I need you people to do the table. So how is that particular table done? You will just have 4 columns, okay? The first thing is year end. Okay? The first column is year end. The second column will be debenture outstanding. Okay? The third column will be the ratio. And the fourth column will be amount written off. Simple. Okay? Let me just rub this off so it will be easy for us. Amount written off. Okay, so what is the first column? Year end. Second column, how much debentures are outstanding. The third column, the ratio in which you have to write off and the amount of discount to be written off. Amount of discount or the loss. You can mention it like that. Okay. Now, how many years the debentures are going to stay with you? First year, second year, third year, fourth year, fifth year. After 5 years, so I am taking it as 1, 2, 3, 4, 5. What is the value of debentures? 1 lakh debentures, my dear students, please see. 1 lakh debentures at 100. So it comes to 1 crore worth of debentures are going to stay in your balance sheet. Correct? So first year I am having 1 crore. Now come to second year. Are you repaying anything? No, madam. At the end of the 5th year, one particular moment or one shot, I am going to give back the 1 crore rupees to them. Till then, this will be there in my balance sheet. So second year also, same value is there, madam. Third year also, same value, madam. Fourth also, same 1 crore. fifth also 1 crore. Finally, at the end of 5, it becomes 0, madam, because one particular installment I'm repaying back. Okay. So how much debentures are outstanding? The same amount of debentures are outstanding throughout. Now you can ask me, why did you multiply by 100? Because the face value is 100. Even though the person has given 94 rupees to you, at the time of redemption, you are supposed to give them back 100. That is why they have invested in your company for this discount. Now what is the ratio? Same ratio, 1, 1, 1, 1. So 1 is to 1 is to 1 is to 1 is to 1. So the total comes to, what is the total of this? 5. Now what is the total loss here? I have seen 6 lakhs is my total loss. So in the first year, I will take 1 divided by 5. It comes to 1 lakh 20. Second year, again 6 lakh into 1 by 5. It is 1 lakh 20. Third year, again 6 lakh into 1 by 5. It is 1 lakh 20. The fourth year also the same, 6 lakh into 1 by 5, which is 1 lakh and 20. The fifth year also it's the same. So instead of doing it 5 times and showing you, I have done it in one particular formula and I have written 1,20,000 per year. But in your textbook, they are giving you this tabular column so that if you understand the concept for this, the next concept of which is being redeemed in unequal amounts or redeemed in a particular value, not after a particular period, but in between itself, you will have redemption. We will see that question now. The same thing, I want you people to concentrate on the next question, which is the illustration number 12. All of you please see this question. HDC Limited issues 2 lakh 12% debentures of 10 rupees each at 9.4. 10 rupees at 9.4 means 60 paise is the discount given. Under the terms of issue, 1/5 of the debentures are annually redeemable by drawings. The first redemption occurring on 31st December 2022. Now calculate the amount to be written off from 2022 to 2026. So now we do understand that this question is not like the previous question which says simply redeemable after 5 years. No, within the 5 years, every year you are redeeming some portion. So now first step for us is to calculate what is the amount of capital loss. What is the amount of capital loss in this illustration, my dear students? It comes to 2 lakh worth debentures, HDC Limited, illustration number 12. HDC Limited is issuing 10 rupees worth at 9.4. So 2 lakh debentures into 0.6 gives me 1,20,000. This is my total capital loss. Okay, I have found this out. Now the second step is how much is redeemed every year. Okay, how much is redeemed every year. So in the first year, I have 2 lakh into 10. That is nothing but total value of 20 lakhs is there in the first year. At the end of first year, what happens? At the end of first year, I am redeeming 1/5. So what is 1/5? It is 4 lakhs. So this 4 lakhs I am redeeming every year. That is the meaning. The same amount of 4 lakhs I am redeeming every year. Now, how does my presentation change? It is the same presentation, not much changes. Okay, year 2022 end. I am talking about year end. So 1st of January they issued. Now I am talking about that particular year end, 2022, 2023, 2024, 2025, 2026. What is the amount? Here there is a difference. All of you please see. First year I am having 20 lakhs at the end in the balance sheet. What is this 20 lakhs? It is nothing but 2 lakh into 10. Irrespective of whatever discount you're giving, the debentures will be shown at the face value, correct? Now what happens to the second year? How much you are redeeming? I am redeeming 4 lakhs throughout. So in the first year, at the end of the first year, this 20 lakh minus 4 lakh, after I give them back, I will have only 16 lakhs at the end of 2023. Now come to the next year. Again from the 16 lakhs, I am giving off another 4 lakhs. Okay. People, please remember, originally what amount you find out, this only you have to redeem. It is not like after getting 16 lakhs into 1 by 5. Don't do that, okay? Originally, the amount that you are going to redeem will be throughout the year same value, okay? But the debenture balance keeps reducing. That is what you need to understand. So from 16 lakhs, I am reducing this 4 lakhs. So third year, I am getting 12 lakhs. Then next year, what happens? Another 4 lakhs I am redeeming, gone. The last year, fifth year, 4 lakhs is there, and I repay 4 lakhs, it becomes 0. Okay, but here you are not supposed to show 0. You need to start from the first value till the last value. That is, after this, it has to become 0 in the sixth year. So, sixth year beginning, nothing should be there, because they have given you in the question that the debentures will remain for 5 years and you have made the account for 5 years. Now, come here, very simple. Make a ratio for this. Like in your sum of the years digit method, you are supposed to make a ratio. How will you make a ratio? Cut off all the zeros. Okay, take 4 table. Take 4 table. 4 ones are 1, 4 twos are 2, 4 threes are 12, 4 fours are 16, 4 fives are 20. So 5, 4, 3, 2, 1 ratio. When you add this, you will get 15. How, madam? 5 plus 4, 9 plus 3, 12 plus 2, 14 plus 1, 15. That is the total. Or you can do the formula n into n plus 1 by 2. Okay. So what is n here? 5 years. Repayable after 5 years. 5 plus 1 by 2. It comes to 15. Either ways you can do. Now come to this column. Very, very important. How much is my total loss? My total loss as computed comes to 1,20,000. So in the first year, 1,20,000 divided by 5 by 15. So it gives me 40,000. Okay. Now when I go to the second year, 1,20,000 into 4 by 15. So now this gives me 32,000. Now 1,20,000 into 3 by 15. This gives me 24,000. 1,20,000 into 2 by 15. This gives me 16,000. And the last one, 1,20,000 into 1 by 15 gives me 8,000. So when you add these together, which is 40,000 first year, 32,000 second year, 24, 16 and 18, the total adds up to 1,20,000. So the first year I will write off 40, second year 32, third year 24, fourth year 16, and the last year 8,000. So did you understand the difference between this method and the method that we actually followed in the first thing? In the first method, the same amount was written off. I just divided the capital loss value by 5. Finish question. Even if I wanted to convert here, this debenture value remained the same throughout. No change. So 1 is to 1 is to 1 is to 1 over question. But here, my dear students, you need to be very careful to see how much is redeemed in the particular year. It says 1/5 is redeemed. So for 20 lakhs into 1 by 5 is nothing but 4 lakhs. 4 lakhs is redeemed every year, meaning which 20 lakhs in the end of the first year. End of the first year, you are going to give off 4 lakhs. Then it becomes 16 lakhs. End of the second year, you are going to give off 4 lakhs. It becomes 12 lakhs. Then again 4 lakhs, it becomes 8 lakhs. Again you give 4 lakhs, it becomes 4 lakhs. No, the question will be, why are we taking 4 lakhs each year, madam? Because that is the fixed rule which says whatever is the total on that 1/5 value I am going to write off. So 4 lakhs is the standard value. Each year I am going to write off in such a way that at the end of the 5 years my balance will become 0. So since this is not equal, you cannot take 1 is to 1 is to 1 is to 1. No. Remember your sum of the years digit method where the ratio should be calculated. And for the first year you will take that year's how much is the ratio divided by the total, and you are going to apportion that particular value. As simple as that. Okay. Okay, good. So now with this particular concept of writing off the loss either in equal installments or in this particular decreasing value where a portion of the debentures are written off, this is the concept. That's all. Now, with this concept, we officially close the unit number 3, debentures. Clear? I have told you. I am also asking you people to practice. So, if you start practicing, everything will look easy. As I was again and again and again telling you, accounts to be practiced, nothing to be studied, nothing to be by hearted. The more you practice, you will improve on your particular speed and also the presentation. So in all of these particular units that we are doing exclusively the journal entries. So please remember to write the presentation format which is in the books of so and so company, the journal entries, and your particular table or the journal entry table will be a 5 columnar table. The first column for the date, second column for the particulars, the third column for the ledger folio, fourth and fifth column for the amounts to write your debit and credit. Narrations, don't forget. If in the question dates are given, please write the dates. If it is not given, just leave it blank. But narration to be mentioned. Ledger folio, just leave it debit and credit. Please write it. Should I end at the end after finishing the question? Should I tally or should I add all that and give it? Not required. Okay. Now we go on to the most important concept, the next unit, which is the bonus shares and the rights shares. So these are some concepts that has been issued. I mean, that has been pushed from your intermediate into your foundation. But trust me, actually, this is one of the most easiest concept. And when you do it as a particular chapter as a whole together, you will have the understanding of the entire company accounts in depth. Okay. So now we are going to talk about exclusively 2 conditions where the shares are issued as bonus. Shares are issued as a rights issue. So when I'm talking, I'm stressing on the word shares. So debentures is over. Now we have come back to the original concept of shares. Okay. And that too shares, I am talking exclusively only about the equity shares. Clear? Now the bonus issue is discussed in section number 63 of your Companies Act 2013. Okay. And this particular section, it authorizes the company, if the company wants to do a bonus share, it can do it from its own reserves, but there are few conditions. So there's a lot of things that's coming here, but first we need to understand what is bonus. When you are working for a company or something, or wherever you're working, if they want to appreciate you, if they want to recognize you, if they want to reward you, they will give you an extra pay. That is called as bonus. So anything extra over and above that you are having or you are entitled to is called as a bonus. That's how we all understood. The same concept is coming here in the shares. So whenever the company wants to issue bonus shares, it means that it is trying to give a benefit to the shareholders. To whom? Existing shareholders. What is the benefit? I will give you additional shares, but are you required to pay me money? Not required. At zero cost to the shareholders, the company is just issuing additional shares. Madam, why will any company do this? Technically, I want to issue shares for the purpose of getting money into my business. I want to grow my business. I want to expand my business and then give back the returns to them when I earn good profits. What is the use of bonus shares, madam? My dear students, when a company is got high on reserves and surplus, I will talk about what are reserves and surplus. But when a company has got huge profits, all of them will be taken to your reserves and surplus in your balance sheet. Where a company has got heavy reserves and surplus, in order to not get unwanted attention, seeking so much profits are there, it can convert those profits or it can take the profits and give it to the shareholders as bonus shares. Okay, so the bonus shares is also called as capitalization of profits. Nothing but in the balance sheet, if you look at from the reserves and surplus, the amount is getting subtracted. It is going and getting added to your share capital, which means that the profits are taken and given in the form of the shares. But please remember, are you getting any money? Is the company getting any money? No. Just the number of shares are increasing. Company gets zero money. Whatever profit it has, it is just converting them into the shares. That's all. Okay. The first concept or the first condition you people have to remember when a company wants to give bonus shares is technically the Articles of Association AOA has to authorize for the issue of bonus shares. Okay, there should be a clause in your AOA stating that company, if in the future it wants to issue the bonus shares, it can do. That should be there in the Articles of Association. This is the first condition. Now comes the second condition. What is the second condition? It says, suppose let us take the authorized share capital, or the authorized shares are 1 lakh shares. Okay. Now already issued are, out of this 90,000 shares are issued. Now I am going in for the bonus shares. I am issuing 15,000 shares. So now what happens when I add? It becomes 1 lakh shares, which is more than your authorized shares, right? More than your authorized shares. So what am I supposed to do? You told me technically when I was doing unit number 2, nothing can be more than authorized, madam. That is, I can only issue up till 1 lakh shares. But here I have 90,000. Now I am doing bonus shares because I have profits, but it has exceeded the authorized shares. Can I do this? Yes, you can do this, but there is a condition. What is that? In the general meeting, the company has to pass a resolution, the normal resolution authorizing to increase the authorized capital. To increase the authorized capital. Okay, increase the authorized capital. So if this is done and the copy of the resolution along with the bonus issue should be filed with the registrar of companies, because with the registrar of companies only you have filed MOA, AOA, telling them this is my authorized capital. Now due to the bonus issue, when your authorized capital is exceeded, you can still do it by passing a resolution in your general meeting stating that due to the bonus issue, since the authorized capital has increased, we are authorizing the entire capital to increase now. If you do like that and give that information to the ROC, if you file it with them, it is valid. Clear? So the first thing is your Articles of Association should authorize for the bonus issue. Second thing is, if this case happens, then you should pass a resolution. Okay? Then the third condition is, my dear students, all the statutory dues should have been paid. That means what, madam? Statutory dues means anything that the company is supposed to pay as a part of a legal obligation. So if you have more profits, immediately you cannot do bonus issue. You should satisfy this condition. If you have any other pending statutory obligations like ESI, PF, TDS or GST, whatever it is, first that amount to be paid from the profits. After making payment of statutory profits or your provisions also, if you have profit, then only you can do the bonus issue. So ultimately what is happening here, the company is restricted to that state wherein first you are supposed to be a good company, not a defaulting company. You should pay all your liabilities, statutory liabilities. If you have taken a loan, you should have paid the interest and principal on the loan, or at least you should have amount segregated separately apart from the profits. Then if you have enough profits, then I can do bonus issue. So the bonus issue can be done to the equity shareholders only after every other payment is being done. If there is a statutory due, I should pay that then only. And then if there is a loan taken by you, then the interest and the principal, you should have made provisions, or you should have kept some amount aside, or you should have paid that amount. So no default should be there. Earlier loans also you should have paid. So if all these conditions are satisfied, only then you can issue the bonus shares, and that too, the word used is fully paid bonus shares. Madam, why are you stressing on fully paid? I will do that because in questions they will say face value 10 rupees. Okay, what is this? face value 10 rupees, but paid up value 8 rupees, or called up value, let us say called up value 8 rupees. That means what? Still out of the 10, 2 rupees is remaining. How much is remaining? 2 rupees is remaining. So what I should do first? I should make the final call. All of you, please remember the Act says, as per section 63, a company can issue fully paid bonus shares. It is not just telling only bonus shares. Fully paid bonus shares means now whatever is there, the face value fully should be called up. If only a part of it is called up, like in my example, only 8 rupees out of 10, first make the call for 2 rupees. What are you supposed to do? Make the call for 2 rupees. Now I will have to pass one single call entry. What is that? What are the entries? Share final call account, debit to share capital, then bank account to share final call. That I have to pass. So in the question, when you are reading, the first and the foremost thing you should check is whether the equity shares for which you are trying to do a bonus issue fully called up or not. If not fully called up, first make that call, like this case. Clear, everybody? So then you can issue fully paid bonus shares. What are all the conditions to be satisfied? First condition, articles of association should authorize the company to issue bonus shares. Second thing, if after issuing the bonus shares, my total shares are exceeding the authorized number of shares, then what I should do? In my general meeting, the board of directors are supposed to pass a resolution, and you are supposed to tell in the resolution that I want to increase my authorized capital because bonus issue, if I do, they are increasing. This should be there. The resolution should be passed. Copy of the resolution and the bonus should be filed with the ROC. Condition number 2. Condition number 3, you are telling so much profits are there. Okay, not my problem. But before you can do the bonus shares, whether all the statutory dues of the company are paid. ESI, PF, TDS, GST, all of this are paid. If they are not paid, then what is the hurry for you to do bonus shares? First pay these values. If the company is a good company, not defaulting in this, then only issue fully paid bonus shares. Condition number 4, if I have taken a particular value, or if I have already issued a loan, taken a loan, then if the loan is paid or not, are you paying the interest or the principal? Yes, then only go and issue the bonus shares. I will take your doubt, Gauri. Please listen to the class. Is this clear, everybody? So these are the conditions, and one of the most important point is fully paid bonus shares. What is this fully paid bonus shares, madam? Fully paid means sometimes in the question partly can be called up, like face value can be 10, but I would have called up only 8 rupees. In that case, I am supposed to first call that 2 rupees value, then only go for bonus issue, because the act says first make it fully paid, and then only go for the bonus issue. All of this is okay, madam, but what are the reserves or what are the accounts from which I can take money for issuing the fully paid bonus shares? Most important thing. The sources of making a bonus issue is completely grouped under your reserves and surplus. Okay? It is completely grouped under the reserves and surplus. So the first account that we will be touching, this will be the order. Capital redemption reserve. Now, what is this capital redemption reserve? For redeeming your preference shares. So in the last unit, we talked about redemption of debentures. What did we do? We did few things. In the next unit, after this unit, unit number 5, we will exclusively talk about redemption of preference shares. In that, the one of the most important thing is you should create this particular reserve. Okay. So after the preference shares are redeemed and gone, this redemption reserve will be there in your balance sheet. Excess amount you created. So your fully paid bonus shares should be first taken from this particular account. First priority. Second priority. Okay, let me write numericals. Second priority comes to securities premium. Madam, what is securities premium? I have already issued the securities at premium. It can be shares, it can be debentures. It is an additional benefit due to the good name of the company people are ready to pay. I take it. I put it into a separate account called as securities premium. And the securities premium completely talks about in the section 52. What happens? It says securities premium account can be used for issuing fully paid bonus shares. That's the first thing it can be used. So securities premium will be given the second position. This is nothing but collected in cash will be the word specified. That means against the securities, when you are getting the money, you will get it in bank or in cash. No, that value you can use it. Then comes the third one, your general reserves. So these are given the third preference. What is general reserve? In a particular year, I have more profits. So when I have the profits, I am taking a part of it, putting it in the reserves and keeping. Maybe in the future, I might want to use it for any purpose the company wants. In that case, if my general reserves are more, I can use it for issuing fully paid bonus shares. Clear? Then the last one can be your current year profit and loss credit balance. Even if this amount over, not the bonus shares still have need money. Then securities premium, that amount over, still money needed. General reserve over, still money needed. P&L account will be also taken. These are the four things, and your questions will definitely finish in these four things. Clear? What are the reserves? What are the order in which you have to take, ma? For issuing fully paid bonus shares, the reserves which are there in the reserves and surplus in the order of first CRR, capital redemption reserve will be taken. Then securities premium will be taken. That is collected in cash. Words are important. General reserve will be taken and P&L account credit balance. Now there is something called as revaluation reserve. Even if the question gives you revaluation reserve is there, will you take it? No, you are not supposed to take the revaluation reserve. What is the logic, madam? Technically only those reserves where there is cash and profit balance only you will take, but revaluation reserve is a notional reserve. I will explain what is a notional reserve. Today, I am purchasing an asset for manufacturing garments. The value of the asset is 1 crore. It is a huge asset. So when the business after 2 to 3 years, it wants to revalue the asset, which means that after 2 to 3 years, there would have been depreciation on the asset, correct? So the value of the asset when it wants to revalue and check, it so happens that the similar asset to purchase in the market after 3 years comes to 2 crore rupees. That means has the asset value increased or decreased? Even though you have used that 1 crore asset for the 3 years, even after charging depreciation, technically the understanding is asset value would have come down. But instead of showing it at a lesser value, when you go and inquire in the market, the people say, no, whatever machinery you are having, very good. It has increased. The value has increased now. So now what happens? You want to increase the value. But technically you tell me, are you getting that cash? Any cash is coming inside due to this particular valuation? No, it is just for the purpose of valuation of internally in your books. Asset value will increase. The same time, under your liabilities, you will show this revaluation reserve. But technically you tell me whether somebody had given you money for that particular machinery value increase? No. Based on your assumptions, based on your inquiry, you understood that the value is higher and that is why you are creating a reserve. So technically the meaning is there is no money here. It is a notional thing like depreciation, correct? It is a non-cash expenditure. It is a non-cash revenue here. So you're not supposed to consider the revaluation reserve. What is that? Don't consider the revaluation reserve. What are the reserves that you have to consider for the issue of the bonus shares, my dears? First thing is the capital redemption reserve. This is a reserve created for redeeming your preference shares, which we will be seeing in the next topic. But the thing you have to remember is once after the preference shares are redeemed, this reserve is no longer required. So what I will do, I can issue fully paid bonus shares. Then comes the security premium. Then comes the general reserve. Then comes the P&L account credit side. As simple as this. Now, before we go into the problems, I would like to show you one particular concept. What are the steps is? What are the steps is? The first thing is ratio. They will give you in the question, say for example, 2:3 bonus shares are given. What is the meaning of the ratio? You first need to understand that. Without even understanding this, how will I go and solve a question? It is difficult, okay? When I say 2 is to 3, the first number is always the bonus shares they are going to give. And the second one is the existing shares. Okay. The first one means how much they are going to give. The second one means how much you are holding. Simple meaning. 10,000 shares are there in the balance sheet. Now the company decides to give a bonus issue in the ratio of 2 is to 3. So what is the meaning? 3 is the second number is always the existing share. So I divide by 3 and then I multiply into 2. So for every 3 shares you're holding in the company, you will be receiving 2 shares. So let us make this as 15,000. There'll be points, decimals coming up, okay? So 15,000 shares, there are shareholders in the company existing. To them, I am going to give it in the ratio of 2 is to 3. The meaning is the second number are the existing shares. So 15,000 existing shares divided by 3 into 2. So the bonus shares I will be allocating is this. One, they can ask you like this. They can give you the ratio and ask you to find the shares. In that case, what will happen? The first number is the number of bonus shares you want to give them. The second number is always depicting how many number of existing shares are there. So take the second number into the denominator, multiply the first number under your numerator. You will get the number of shares. Sometimes they can say, for every 4 shares held, 1 share is given. Like they can give it to you in the form of a statement also. In this case also same. What is the difference? For every 4 shares held, that means these are the shares held. How much are you getting now? 1. So this is 1 is to 4. Even if they give you a statement, you should know how to convert it. How many number of shares held? That is the existing shares come in the second place. How many shares you are going to give? That will come in the first place. 1 is to 4. So the same thing if I have to apply here, it will be 15,000 into or divided by 4 because second number becomes the denominator. This. So it comes to, I think 3250. hmm? Hmm. 3250 shares. So computing the number of bonus shares is very important. So I can give a or I can get a direct ratio given to me in the question, or I can get it here in the form of this particular thing. What is this particular thing? I can tell for every 4 shares I am giving 1 share, or for every 3 shares I am giving 2 shares. Then also please convert it as this particular ratio and do it. Okay, just 2 minutes go through the concept. Just 1 minute. Now let us go ahead and see the question number. Let us start with the illustration. Quite a simple concept, okay? Just 5 illustrations. But the concepts that you are understanding or you will be learning is a little more, okay? So now all of you please see. One of the most important and easiest concept, okay? So they might test you. So let us go ahead and now see. Okay. Okay. Okay, so it says accounting for the rights issue and bonus issue. First, we are talking about the bonus issue. Okay. See here, Alpha Company announced bonus issue to its shareholders in the ratio of 2 is to 3. 2 is to 3 meaning is first 2 shares are the bonus shares they're going to issue. This 3 is nothing but the existing number of shares. That is 2 shares for every 3 shares held. A shareholder has 6,000 shares before announcement of bonus issue. How much shares he would have after the issue of bonus shares? The same example. 2:3 bonus shares here, but here the value changes to 6,000. The existing number of shares, which is the second part of the ratio, will come here, and the first part, how much I am going to issue. So it will come to a total of 4,000 shares. That is your particular example number 1. Okay. Now let us come a little down. So the provisions of the Companies Act section 63 says fully paid bonus shares. See here the word issue fully paid bonus shares out of its free reserves, that is capital redemption reserve or the other general reserve and everything, and this will come there, a securities premium and capital redemption reserve. Okay. So the first thing is it should be authorized by its articles. Then on the recommendation of the board, in the general meeting of the company, there should be a resolution passed. The company should not have defaulted in the payment of interest or principal in respect of the FDs or the debt securities issued by it. It has not defaulted in the payment of the statutory dues of the employees. If there are partly paid up shares made fully paid up, and finally you can go with the issue of the bonus shares. That is what I have taught you. Now we should talk about the entries. Madam, you taught everything. Who will talk about the entries? Simple, my dear students. There are 2 entries for the bonus shares that we are issuing to the shareholders. Okay. So all of you please see, since we are converting the reserves into the capital, the reserves will have a credit balance, correct? Because they come onto the liability side, they'll have a credit balance. When you take money from them, they decrease. So all the reserves will be debited. The first reserve I was telling you, capital redemption reserve, debit. Capital redemption reserve account, debit. Then we have securities premium account, debit. Then we have general reserve account, debit. And then we have the P&L account, debit. To bonus to equity shareholders account. So this is the first entry that I will be passing. How many accounts I'm debiting? 4 accounts. Sometimes you need not debit 4 accounts because you should first calculate the value of bonus value shares. So after you arrive at the shares, if from the capital redemption itself you are able to take full amount, super. If not, go to securities premium. If this is also not enough, go to the general reserve. This is also not enough, go to P&L. It will be enough. In either of the 4 accounts, your accounts will be closed. Now I come to the second entry, which is bonus to equity shareholders. Write full forms. Don't write like me. To the share capital. So ultimately, my share capital is increasing. That is why I am supposed to pass these entries. If you are going to now, my dear students, combine these 2 entries, bonus and bonus will go away. So the reserves have technically been converted to your capital. You are taking amount from the reserves, putting it into the capital. That is why we call the process of bonus issue as capitalization of reserves. It is called as capitalization of reserves. All the reserves are removed, turned into the capital. As simple as this. Now let us go ahead very, very quickly to the interesting questions which are like very easy. I cannot say normal easy, very, very, very easy. That's it. Okay. So upon the issue, this one particular comes. Now let us go to the illustration 1. Now all of you please see the following items appear in the trial balance of Bharat Limited, a listed company, as on 31st March 2022. So what you can see, ma, the first one, 40,000 equity shares of rupees 10 each, which is 4 lakh rupees. Then come here. Capital redemption reserve 55,000. Okay. Securities premium collected in cash 30,000. Okay. General reserve 1,05,000. Okay. P&L 50,000. Okay. Now read the question. The company decided to issue equity shareholders bonus shares at the rate of 1 share for every 4 shares held, and for this purpose it decided that there should be a minimum reduction in the free reserves. Pass the necessary journal entries. What are the first step is compute the number of shares. Before we pass the journal entries, we are supposed to know how much bonus shares are being issued, correct? So all of you please see how much bonus shares or how much equity shares are already there in the balance sheet or in the trial balance. 40,000 shares at the rate of 10 rupees each. Now what is the ratio? They are wanting to issue one share for every 4 shares held. So how much will be the bonus shares? Can you tell me? Total shares 40,000 divided by the existing into whatever I want to issue. So I am giving 10,000 shares as bonus. What value? Always the face value. You cannot issue it at a premium. So 1 lakh, because already this is a benefit for you. You are not going to receive any money. Only when you receive money, you can tell me shares are issued at premium, madam. Now here we are not getting any money. We have excess money. We are giving to the shareholders in the form of additional shares. So you should never get a doubt as to which I have to multiply, always the face value. So I need 1 lakh rupees. Now, my dear students, in your question, it says the CRR, capital redemption reserve, has how much? Look into your trial balance. It has 55,000 rupees. So for 1 lakh, I will take 55,000 from the CRR. But still you need money, no? Yes. Which you should go next? Securities premium, which is 30,000. Now I will take that also. 55 plus 30, 85. But 1 lakh I need. Only 85 is there. So the remaining of 15,000 from which I will take? I also have the general reserve. That is 15,000. So total 1 lakh I have taken from here. So you can ask me a question, madam. Total I have not taken. No, not required. You can have excess reserves. That is not the problem. But from the reserves, you should be able to meet this particular value. That's all. Okay. So did you understand? First, what did we do? What are the number of shares given to us in the balance sheet? With that, we have multiplied with the ratio. After multiplying with the ratio, we understood that, okay, bonus shares is given in this ratio. 1:4 means 40,000 divided by 4 into 1, 10,000 shares. What is the value? I should take always the face value. 10,000 into 10 is 1 lakh rupees. 1 lakh is the amount of the bonus. How did I take? In your trial balance, capital redemption reserve, I told you first preference. It has only 55,000, madam. Then what I should do? Go to the next one. Securities premium. It has only 30,000, madam. What should I do? Go to the next one, which says the general reserve. It has huge balance, but from that I need only the differential of 15,000. Now come back to the entries. The most easiest entries are here itself. It is there. Capital redemption reserve 55,000. Securities premium 30,000. 15,000 here over. So bonus to equity shareholders comes to 1 lakh. And then 1 lakh here, second entry to the share capital 1 lakh. Clear, everybody? Now, after passing, doing the working notes is one step. Passing the entries is the other step. The third one is you are supposed to prepare the extract of the balance sheet. Very, very important. Whenever you do bonus issue, what happens? Reserves are subtracted. Share capital is increased. Correct? Increase in the number of shares. That you should clearly show it in the balance sheet. Clear? That I will show you the presentation when we do a full-fledged question, which is the next illustration. So this illustration, very simple. Illustration number 1. We know that 40,000 shares at the rate of 10 rupees each is given. Ratio is given. So first I find out the number of bonus shares issued to be issued into the face value. This is the value. How will I take the amount, madam? From these particular things available. It is given to you earlier in the question. See how much you need to take. And then we are passing this particular entries. As simple as this. Okay. Now we will go to an illustration number 2. What is this illustration number 2? Let us see. All of you please see this particular illustration number 2. Very easy. Just pass journal entries for these two situations. Okay. Situation number 1. A limited company with subscribed capital of rupees 5 lakhs consisting of 50,000 equity shares of 10 each. Called up capital is 7.5. The moment you see 10 rupees value, called up is only a part value, not full value. What you should do? Make the final call. What you should do the final call. Then only think about bonus shares because the act says fully paid, fully paid. So that should keep ringing in your minds. So the moment you see it is partly paid, make it fully paid. And all of you, please see a bonus of 1,25,000 declared out of general reserve to be applied in making existing shares fully paid. So they themselves have given you directly. So the illustration number 2, the first one will be first make the shares fully paid. How will you make the shares fully paid? Share final call account debit to share capital. First transfer entry, no? Correct? How many number of shares? 50,000 shares into 2.5. How, madam, 2.5? Out of 10 rupees, 7.5 rupees is called. So the remaining will be this value. So 1,25,000, 1,25,000. Transfer entry made. The second entry will be my receipt entry, bank account debit to share final call. Simple. You have already done in your issue of shares. I am doing only one final call entry because I should make the shares fully paid before I am issuing the bonus. Okay. So money received on the final call. Okay. After I do this, what is that given to me in the question? Out of the general reserves, please do the bonus shares of that also same amount 1,25,000. Okay. So now the entry that I have to pass for the bonus shares is general reserves account debit 1,25,000. Here no shares, no ratio, nothing given. Directly they've given you. Simple, madam. I only need to pass the entries. Bonus to shareholders, which is again 1,25,000 credit. So this is when the company decides for bonus issue, and when the actual issue is being done, it will be, you're able to see, bonus to shareholders, debit to share capital. That is the value. 1,25,000, 1,25,000. As simple as this. These are the 4 entries. This is a simple question which is just talking about what is that I should make the shares as fully paid first. So for fully paid, I am doing this particular issue entries for the final call. I am assuming it is final call. Okay. In your textbook, they can combine both the entries and just pass bank account to share capital and leave. That is what they have done. But further, even in your textbook, the next illustration says pass 2 entries for share final call. It is always safer side to pass 2 entries and keep it. Okay. That much I have done. Nothing else I have done. I have first made it fully paid, and then it said out of the general reserve issue this particular 1,25,000, which I have done. Now read the second part. A limited company having fully paid up capital of 50 lakh rupees consisting of equity shares 10. That means what? 5 lakh shares into 10 rupees is the value. Has general reserves of 9 lakh rupees. It was resolved to capitalize rupees 5 lakhs out of the general reserve by issuing 50,000 fully paid bonus shares of rupees 10 each. This is also a straight question which says nothing. It says that general reserves balance is 9 lakhs. Out of that, as bonus shares, I want to issue 50,000 shares at 10 rupees. So how much is the value? 50,000 into 10 is 5 lakhs. 9 lakh rupees I have balance. Out of that 5 lakhs I am going to take and put it as bonus to the shareholders. So just this particular entry, the general reserve to this, the amount alone will change to 5 lakhs and 5 lakhs. For the second part of the question number 2, the second part, this alone will be the entry because already fully paid up. So no problem. I need not once again pass that particular entry because it is completely paid up. Okay. Now, shall we quickly go to the next illustration? These are all very basic, okay? They are just asking you to pass. See, I told you here, all of you, please see. For the first entry, share final call to equity share capital they have done. And the bank account, okay, they have, okay. Bonus to share final call, they have automatically converted. So this entry, we have added the bank entry, pass the bank entry, okay? So the next one is general reserve I'll come back to all your doubts a little bit afterwards. General reserve to bonus to shareholders, and this is 5 lakhs. Now, please see your illustration number 3. Very, very important. This is a full fledged question that can come to you in the exam. So, please listen to this concentratedly. The following notes pertain to the balance sheet of Solid Limited as at 31st March 2022. The authorized capital is 10,000, 12% preference shares. So in the capital, you have preference share capital and equity share capital. The authorized is given only for your information. You need not consider this authorized capital anywhere for calculation. Clear? Now come to the second part. Issued and subscribed. So 8,000 preference shares are issued 80,000. Even with the preference shares, you don't have any work because bonus shares are issued only to whom? The equity shareholders. Now come here. The major part of your question will start here. 90,000 equity shares of rupees 10 each, 8 paid up. The moment you see here, what you should remember, 10 rupees only, 8 rupees paid up, I should first make the final call. I should make the equity shares fully paid, only then I should go for the bonus entries. Without making that fully paid, you are not supposed to proceed. Is that clear? The moment you are seeing that particular part in the balance sheet, you should understand, okay, it is not fully paid. So this equity shares, you should make it up fully paid. Now see the reserves. General reserve is there, okay. Revaluation reserve is also there, 35,000. Will you consider revaluation reserve? No. Give a note in the question stating revaluation reserve will not be considered for the purpose of issue of fully paid bonus shares. That note you should give. Then only the examiners will understand that you have understood the concept. Okay. Then securities premium, yes, I will use. P&L account, yes, I will use. Only revaluation reserve, no, I will not use. Secured loan debentures, generally they have given you for information. That has also got nothing to do with the question. Now please see here. On 1st of April, the company has made a final call of these 2 rupees on the 90,000 equity shares. The call money was received by 20th April thereafter. So they have made the call, or they have made the shares fully paid up. After that, they wanted to, or the company decided to capitalize its reserves by the way of bonus at the rate of 1 share for every 4 shares held. Okay, 1:4 is the ratio. Simple. Show the necessary entries in the books of the company and prepare the extract of the balance sheet immediately after the issue of bonus, assuming the company has passed the necessary resolution after at a general body meeting. So the meaning is, my dear students, they themselves have given here the authorized share capital is crossed, so you can assume that the particular company in its general meeting has already given the resolution for the approval of increase. You don't have to worry about that. Just to do the entries is what they are asking. Clear, everybody? So the first entry I will be doing is the same entry. Share final call account debit to the share capital, correct? So illustration number 3, when I am going to work out this particular thing, the first thing I have to do is make the shares fully paid. For that, what will be the first entry? Share final call account debtor to share capital account. In that, the number of shares is nothing but 90,000 shares into 2. So 1,80,000 shares and 1,80,000 rupees I have received. What are the dates on which I am receiving? 1st of April, I am making the call. 20th of April, I am receiving the money. So I have first passed the first entry in the books of, what is the name of the company? Solid Limited. I am passing the journal entries. Okay. The first entry I have to pass is this. Now come to the second entry. Before I can do all of this, I should do the working notes. No, let me do the working notes to find out how many bonus shares are issued And what is the value? From where I should take it? Very, very simple. Now, after making it fully paid, what are the number of equity shares existing? Number of existing equity shares are 90,000. Simple. Okay. Out of this, the ratio for bonus is 1 share for every 4 shares held. It is 1 share for every 4 shares held. Now I will find out the number of bonus shares, which is nothing but 90,000 shares existing divided by 4 into 1. So I will get 22,500 shares. What is the face value of 1 share? Face value is 10 rupees, correct? So now the value of the bonus issue will be 22,500 shares into 10 rupees. So 2,25,000 rupees I am going to need. I want 2,25,000 rupees here. What are the reserves? We will see later. First, this amount can be filled. Now, can we go ahead and see when the bonus issue is made? What are all the reserves that I have in the question? I have a capital redemption reserve, correct? Now let me rub these amounts and see what are the values that I have to take for this particular 2,25,000. To arrive at the particular value, how much I have to take, I will check out now. So I will share the screen quickly. So for 2,25,000 first, the amount I will be considering it from. All of you, please see. First, I will take it. Do you have capital redemption reserve here? No. Revaluation reserve, I should not take. Next is securities premium. How much in securities premium I have? 20,000. So I am writing 20,000 straight to the capital. No, straight to the reserve securities premium. Next, I have the general reserve. How much is this? 1,60,000. How much is coming in the P&L? It is coming 2,05,000. So all of you please look on to the board. First thing is securities premium I have considered. Then I go to the general reserve, 1,60,000. Now 1,60,000 plus 20, 1,80,000. Minus 2,25,000. So how much is the excess you need? So from the P&L account balance, correct? From the P&L account balance, out of 2,05,000, I am giving away 45,000 only, because only that much I need. So this is how I have taken it from the entire reserves and I have written it here. So these are the entries you people need to pass first. Okay. Now next I am going to show how will you account for this in the balance sheet. Very, very simple. Okay, how are you going to account for this in the balance sheet? But before that, all of you please see, are the entries clear to you? First, there will be a working note here. There will be a working note here wherein you are going to find out the number of shares. Okay, you are going to find out the number of shares here. After finding this, you are going to see from which reserves you are going to take the value. So these are the 4 entries. First, for the share final call, 2 entries, and for creating the particular bonus issue, the 2 entries that you will be doing it. Is this clear? Now, can we go ahead and do the particular balance sheet? Now, I will show you how to write the balance sheet. Very, very important. Don't write anything. Don't see anything. Just look onto the board. We can work out everything. So here we will write in the books of Solid Limited. In the books of Solid Limited, extract of balance sheet. Okay, the words are very, very important. Extract of balance sheet after the bonus issue. Okay, so it will be on in the April month it is being done, right? So the serial number first, and then you have the particulars, and then you have the amount rupees. You have the notes here. Now the first one is equity and liabilities. That will be the heading. Equity and liabilities. Under that we have equity. Under equity, the first note will be for the share capital. and then you will have the reserves and surplus. Because when you do a bonus issue, both these will be affected. So both of these you should first write it in the particular format, okay, in the books of this, and you will be writing it. So when I write notes here, I will again have to prepare a particular working notes here to show. I will be preparing the working notes. So first my authorized capital. I will write authorized capital, which says, correct, that was earlier 90,000 shares. Now after the bonus shares, how much it has become? 22,500. So it will be 1,12,500 into 10 rupees, correct? So the value is 11 lakh and 25,000. Is this clear? So what has happened to my equity shares? Under the authorized capital, below that issue subscribed in this 90,000 shares plus now bonus shares 22,000 shares issued into 10 gives you this value. Apart from this, what else I have in the question? I have preference share capital, that is nothing but 8,000 shares into 10. So it comes to 80,000. So what is the total value of the share capital? From the note, it is 12 lakh and 5,000. How did I get 12 lakh 5,000? Because share capital has equity shares and preference shares. Preference shares, no change. Equity shares, add the value of the bonus and you are taking it here. Add these two and show it here. Now the second and the most important is, how am I going to calculate my reserves? Correct? How am I going to calculate my reserves? This is working note 1. Now we come to the reserves and surplus balance. The first reserve is the general reserve. How much it was there earlier? 1,60,000. But now what you have done? You have given or issued for bonus shares. So I am subtracting 1,60,000. There is no balance in the general reserve. The second one is the revaluation reserve. Did you touch the revaluation reserve? No. So how much is the value of the revaluation reserve? Just a minute. Revaluation reserve is 35,000. So the entire 35,000 is not touched. It comes here. Then come to the securities premium. Is it taken? Yes. How much value? The value of the securities premium was, the value of the securities premium was 20,000. So 20,000 minus bonus shares. How much it comes to? 20,000. So this also becomes 0. Then comes your P&L account. Total balance was 2,05,000. But how much you used for bonus issue? Full value? No, I just used only 45,000. Go back to your entry and see, only 45,000 I had used. So 1,60,000 will still remain. What is this? 1,60,000 will still remain. So what is the total of this reserves now? 35,000 plus 1,60,000, 1,95,000 will come here. Clear? And then the next one is long-term borrowings, because we have the debentures in the question. So the long-term borrowings will be, how much is the value of the debentures given to you in the question? Value of the debentures will be 5 lakhs. So under this long-term, under the non-current assets, under this head, you will write the long-term borrowings, which is nothing but the debentures, as 5 lakhs. So this is the extract. When you add everything, 2 lakhs 14, 19 lakhs will be the value. That's all. Only this much you are doing. That is why you are calling it as extract. There is no assets, nothing you are showing. You are just showing the balance sheet after the bonus issue. So this much, actually, when you consider about a bonus issue problem, the problem here is not doing it. Even the ratio will be very easy. Even for you people to identify what is the amount, it will be very easy. Where the actual thing will come is, first do the working note to find out what are the bonus number of shares to be issued, value of bonus shares, Then start posting the entries, which will usually be not more than 4. Okay, when you have to pass the final call entry and then pass the bonus. If final call is already done, only 2 entries will be there for you to pass. Passing journal entry, very, very easy. Now presenting it in the balance sheet is another task. How will this come for you? You have to again and again practice. It is very easy because your share capital is increasing. So you know equity shares will increase. Preference shares remain the same. But for this to be shown to you or to the examiner, you should write, it will be a long thing because here I will show only share capital. I will show the total value. Again, for this, I should make a note here. Again, when I come to reserves and surplus, I know some reserves are getting reduced because I've already passed an entry. To give effect to that entry, I should again open the note and show general reserve so much, how much bonus it has gone. Revaluation reserve, I have not touched. So take the entire value. How much securities premium I have used. How much P&L account I've used. So all of this, I should give it in the form of a note. Then I will have to come back here and take the total value. And since the debentures are also given, don't forget debentures are your long term borrowings, which I have already told you. So this is one full question, which is your illustration number 3. Now with the same part, let us go ahead and check the illustration number 4. All of you please see here. The following notes pertain to balance sheet of Preet Limited as of 31st March. Authorized, again you have preference shares given to you, and then you also have equity shares. Out of the equity shares, for you important is only this. Then why madam in every question they are giving me the authorized also? For you to understand that in every case, how much ever issued plus bonus, if it is exceeding the authorized share capital, you people have to give a note that it is assumed that the company in its general body meeting has passed a resolution and the company will be doing accordingly, and we are going ahead and we are passing the entries in the under this assumption. Is this clear? So we have issued and subscribed in that how much ma? 1,35,000 equity shares of 10 each, rupees 8 paid up. So the first thing is when you see this question, what you should do? Make it fully paid. So the last call of 2 rupees should be called on 1,35,000 equity shares. What will be the entry? Share final call account debit to share capital. Bank account to share final call. The amount will be 1,35,000 equity shares into 2 rupees. So 2,70,000 and 2,70,000. First 2 entries you should pass this. Okay. Now come to the reserves. General reserve I can use? Yes. Capital redemption reserve? Yes. Securities premium? Yes. Profit and loss account? Yes. Now you tell me what will be the nature or the order. I have all the 4. First capital redemption reserve I will use. Then I will use securities premium. Then if I want anything else, general reserve. If this is not sufficient, only finally I will touch P&L account. Is this clear? So now we have passed the entries, which is the share final call account debit 2,70,000. How madam 2,70,000? 1,35,000 equity shares. 2 rupees is not called because 10 rupees face value. 8 rupees is your called up value. So it is 2. 135 into 2 is 270. 2,70,000, 2,70,000. When I receive money, it will be bank account to share final call 2,70,000, 2,70,000. This is clear, madam. Now the reserves. All the 4 reserves are there. That is also clear. Now what you should check in the question? For the ratio, we should find out how many bonus shares are issued, correct? Now all of you please come here and then now let us check what is the ratio given to us in the question. Ratio given to us in the question is as simple. Just a minute. Yep. So seeing here, on 1st of April, the same thing, it is received, decided to capitalize by at the rate of 1:2 for every 4 shares held. Same thing. So here the number of shares will be very easy. I will be doing 1,35,000 shares divided by 4. So I will be getting 4 3s are 12, 15, again 3. Okay. 12, 15, again 3, 3, 33,750. So I am getting 33,750 shares. So what is the value? 3,37,500 is the value of the bonus shares. Right? Now let us look into directly your textbook and then close this question. Quite simple, same like your earlier question, nothing we have done extra, nothing we have done less also. So the first entry is equity share final call to equity share capital. And then when I make a call, I mean, when I receive money, it is bank account debit to the equity share call. Okay. And now this 3,37,000 we have arrived. No. How did they take? So the first one I told you, they are using capital redemption reserve fully, securities premium fully. So all of you please see, out of 3,37,500, these two are being used completely. So 60,000 plus 37,500 is 97,500, but still they need money. So 97,500, then they're taking general reserve 1,80,000 completely. After taking the balancing figure of 60,000 alone, this coming from the P&L account. How am I doing this? You can put all the reserves in the entry itself directly, you can write and take it. Now people, you tell me, in the P&L account, if 60,000 is taken away, the total is 3 lakh minus 60,000, 2 lakh 40,000 will be remaining. That will come in the reserves and surplus. Yes, am I right? Now, when you go to the balance sheet, you will show the balance sheet like this. See here, issued and subscribed. See, extract of balance sheet, they have given here itself. See, you can do it like here and here, show it separately like what we have done. But in this question, they have combined and given to you. How it is given to you? How 1,68,750 it has become? Earlier, I had 1,35,000 shares. To that, I am adding 33,750. So total becomes 1,68,750 shares into 10, 16,87,500 plus preference shares will be this value. Now reserves and surplus will be only P&L reserve is there. In that 3,60,000 gone, 2,40,000 will be there. And here also you have the debentures. So that debentures will be coming under the long-term liability. That's all. Oh, here there is no debenture, so there is no long-term liability also. So I want you people to go back, sit and work out your illustration number 3, illustration number 4. What are the effects of bonus issue? After I do the bonus issue, as I was telling you, reserves balance will reduce, my capital balance will increase. In other words, my number of shares which is there in the balance sheet would have increased. So this will be, or this is considered as a favorable move by the companies, because only when you have performed so well, you will get so much profits. Only if you have so much profits and you have conditions, everything you have satisfied, you will be able to do the bonus issue. So it gives a very positive outlook on the face of the company, and that is why the market will become favorable. But the actual thing is, number of shares will increase, but cash will not increase. So that is why your EPS or earnings per share will come down. Why are you teaching this concept? Is practicality angle also I am telling you. So you should not be only doing, okay, this is thought, I should do this accounting treatment over. No, practically also you should be able to see how you will apply this in the future. So when a bonus issue is being done or given by a company, it is usually talking about a favorable situation of the company. Is this clear to everybody? And then we have a very small concept of the rights issue. Okay, so technically talking about your particular unit talks about both bonus issue as well as the rights issue. So the second concept or the second part of the concept says rights issue. So as you can see, this is also something concerned with the issue of equity shares. So the shares, equity shares, sometimes what happens is, if the company is in need of money, it needs to make a particular issue. So the Companies Act or the SEBI also says that always don't go for issuing the shares to new people once again. There are existing shareholders in your company, for your company, who have already taken the shares. So what is the hurry for you? First, if you want to issue additional shares again, please go ahead and first offer the shares to the existing shareholders. Make an issue to the existing shareholders. Okay, so this is given to them. Okay, existing shareholders at a lesser price. So that is the meaning of a rights issue. As a matter of the right, technically the people who are existing as shareholders will get a right to get a particular share, like if they want to issue additional shares in that, the first preference should be given to the equity shareholders. Why? Because they don't want to dilute the power. So what happens if new people are coming in? Already there are 10 shareholders and the share capital is divided among them. The voting rights, the power is distributed among 10 people. Now I want to issue additional money, additional shares. So in this case, what happens is, instead of inviting additional 10 people new, first I will issue those shares to my existing 10 people so that the total owners remain the same, 10. If I'm going to give again 10 people new, it will become 20. The power gets diluted. So any company will not want the power to get diluted. That means add so many people it wants. No. In that case, the rights issue is being done. Okay. The rights issue means offering the shares of the company to the existing shareholders at lesser price. Market price can be anything, but I am wanting to issue the shares at a lesser price. Then it will be called as rights issue. Here, the existing shareholders will have the option to take the rights issue shares or to reject the rights issue shares. To take the rights issue, okay, I am going to give you only additional shares. Simple, you give me the money, finish. So for a rights issue, again, coming as allotment application, that and all is not there. One single allotment, one single installment, I'll take the money, finish. So it will be a usual entry, okay? When the rights issue is accepted by the person, then finish. Question over with that. If it is not accepted by the person, he wants to reject it. That means instead of me having the rights issue, taking that benefit for myself, let me not take it and let me give it to somebody else. So that's called rejection or renouncing the right in favor of others. It technically means you will get a benefit, and if you don't want that, you don't want to get money from that, you can sell your rights to the other person also. Okay, because you are willingly, wanting that, okay, even if the power goes to somebody else, gets diluted, what is my problem? I want money. So when I am selling my portion of the shares to the outsiders, it's called renouncing your right. I don't want the ownership anymore. Additional shares, I don't want. Let you take, be happy. I will get some amount from that. Okay. So how to calculate that sum amount? There are two important formulas. The entire rights issue, after you understand the concept, is very, very, very easy. Just only one illustration is there, and that too, the illustration is based on two formulas. So did you all understand what's the rights issue? The issue of shares to the existing shareholders that the company does for money. This is not bonus issue, free of cost and all. They're not doing. They are giving for money, but at a lesser value than what actually the market price is. Okay. So now after I give you this, the shareholders can have two things. One, the shareholder can accept it and give the company money, become the additional shares he can get at a cost, lesser cost. The second thing is I want to reject it or renounce my right. That means in favor of somebody, I am transferring these particular rights for which I will get a money. I will get some money. How will I calculate it? All of you please see. The first important formula is value of a right. I have got the right. I want to transfer the right to somebody. What value he should pay me? That is the value of the right. The value of the right is nothing but price of the shares or market price of the shares minus the X market price of the share. What is this what is this X, madam? Simply, it means the market price of the shares before rights issue. Before making a rights issue, what is the market price? That is called as the price of the shares. After making the bonus issue, what is the market price? So the difference in the market price of the shares before and after issue will be called as the value of right. For example, 150 rupees was there as the market price before the bonus issue. It now became 145. So technically the value of share is 5, and how many ever shares I am selling, that person should pay me those many shares into this value. That will be the amount I am going to receive. So the first formula, important formula concerning the rights is what is the value of a right? Okay, come price of the shares minus the X price of the shares. What is come price? Very easy. Come price, or you can also call this as come right value of the share and X right value of the share. Just the names are differing, but what is the meaning? Before doing the rights issue, what is the market price? After doing the rights issue, what is the market price? That is this. Madam, from where will this come price be given? It will be given to you in the question. Don't do anything. From the question, if you read that the current market price is so much, it means that before rights issue, that is the market price. It will be definitely given to you in the question. Then what about the X right value, madam? This you need to do the second formula. Okay. The first formula is very easy. Come right value minus X right value. Come right value is the market price of the share before rights issue. X right value is the market price of the share after issue. That's all. If you subtract both, you will get the right value or the value of the rights. So when the share is or a company is making a rights issue, what is the right value? That is what I am seeing here. Okay. Now come to the second most important formula. How to calculate the X right value of share. Please see here, very important. Come right price, which is nothing but the market price. I just now told you in that above formula, no? The same value you are going to take and multiply with the existing shares. Simple. While learning only it will be difficult. Otherwise it's quite simple when you do the question. Plus. What should I do, madam? Plus. Simple. How many rights issue or how many rights issue shares I'm going to get into the issue price. This will come in the numerator, and here it will be existing shares plus rights shares. When you're first learning the particular thing, it will be a little confusing, but it will get okay once when you start looking at the question. Now let me do this particular question for you, which says directly we'll go into the question. Okay. Illustration number 5. Yes. All of you please see, a company offers new shares of 100 rupees each at a 25% premium to the existing shareholders on 1-on-4 basis. Okay, on 1-on-4 basis. So what is happening in the illustration number 5? A company is issuing the right share, correct? The right share is issued at what value? So the right share is issued at 100 plus 25% premium. So the value of rights issue is 100 plus 25, 125 rupees. Okay. Next ratio is important. 1:4, where 1 is the rights issue shares and 4 is the existing shares. If you are holding 4 shares in the company, I will give you 1 share as right share. Is this understood? So when they are talking about a company wants to issue the shares as rights issue at a particular value, it is nothing but the issue price which the company is intending to do for the rights issue. That's all. Take the ratio. Now go back to the question. Now the question further says, all of you please see, the Come right market price is 150. Calculate the value of a right and what should be the X right market price of a share. So now please see here, come right price is 150. So there are so many things given to you in the question. After understanding, go back to this formula. Simple. What is come right price? 150. What are the existing shares? 4 shares. Plus, what is the rights issue number of shares? For 4 shares, I will issue 1 share. 1 into what is the issue price offered by the company? It is 125. This is the numerator. 150 is the come right price given to me in the question. Existing shares, I have taken it from the ratio. 1:4 means 4 existing shares. 1 is the new share. So I am taking 4 existing shares plus what is the, how many I am going to issue rights issue? 1 share. For 1 share, what is the value? It is 125. I have now done this. Divided by existing plus rights issue comes to what? 4 shares existing plus right shares is 1. So 150 into 4 is 600 plus 125 divided by 5. So it comes to 725 divided by 5. The value of one particular share is coming to 145 rupees. This is nothing but the X right value. What is this? X right value. Now the last one, nothing but you should calculate the value of the share. Correct? I mean value of the rights. Rights issue, what is the value? Rights issue, the value is nothing but come price, which is 150 minus the X right price, which is 145. 150 minus 145, 5 rupees is the value of the right. What is it? 5 rupees is the value of the right. So now what happens for the rights issue is, correct? So 125 rupees if the rights is being done, people will get it at this particular value of 125. Okay. But if you are already a shareholder in the company, if you pay how much you will get this right, not at this value, but you are already holding the 4 shares in the company. Now 4 into 5 shares, the 20 rupees if you pay, you will be getting the rights issue, that is allocation of this 125 rupees, because one share is 125. I am giving to you at an offer. The value of the right is 5. So 5 rupees into existing number of shares is actually the value of the right. So with that, or this is one particular typical concept, or this is the only concept that is coming to you in the rights thing, and it is very, very easy. So accounting treatment is, I will get money, so it will be bank account to equity share capital. And here, no, at 100 plus 125 I have issued, no. So that 25 rupees is the premium. That's all. Okay. Advantages, disadvantages. What can be the advantages? What can be the disadvantages? Advantages is you will get additional money into the business. And the second thing is the additional money also, it will not dilute the ownership. Whoever is the owners, they are only getting for the additional thing. And what are the disadvantages? Sometimes when a rights issue is being done, no, always after the rights issue, the market price falls down. So that can be seen as a disadvantage. So this is the same thing that we have seen in the illustration number 3. Illustration number 1. The following are appearing here. The company decides to issue 1:3 shares. So please pass the necessary journal entries. This is a bonus issue. Also deals with all of you. Call, and then 2 for every 5 shares bonus shares are being done. Again the same thing here also. They have just changed the numbers and given to you. Try the practical question number 3 also. Now please see here. Okay, a company has decided to increase the existing share capital by making a rights issue. The company is offering 1 share for every 2 shares held. So 1:2 is the ratio. Market value, come price is 240. Company is offering 1 share of 120 each. So this is the issue price. So whatever we have done now here, the same question, if you can work out the practical question number 4 and do it, it is going to be so simple. Okay. First, take this, memorize the formulas, and then if you are going to put it in the formula, it is going to be really very easy. Okay. Now please come here. Sixth question alone. There is both the bonus shares and the rights issue, which actually is very easy. You need not compute anything here. Okay. Just go down and read it. First pass all the entries, and then the company issued right shares at the rate of 2 shares. So while computing the right shares, already you should take the bonus shares also. So the practical question number 6 alone, when you are doing, first do it like the bonus shares. First final call, do it. Then issue the bonus shares, increase the number of equity shares. So original equity shares plus the bonus shares will give you the new equity shares. On the new equity shares, you are going to apply the percentage of rights issue and take it at that particular value. Okay, try that. In the next class, I will just show you the working note. So with this, the unit number 4 comes to an end. The last and I've taken a little bit more time. It's okay. I will now give 10 minutes for people to ask your doubts, and then we'll wind up this particular question. Okay. In between, we had Gauri was raising her hand. The others also, please kindly get connected to ask your doubts. Nobody is having any doubts. I assume you have understood, and we will meet for the next. Okay, Kavita, I'm just unmuting you. Kindly ask your doubt.
Hello, ma'am.
Yeah, Kavita, please.
Ma'am. I want to ask you that regarding that conditions which have to fulfill by company before bonus issue. Okay, that is to pay whatever statutory liabilities.
Correct.
And all that. Okay. In question 3, illustration 3,
Okay.
there is secured loan, sorry, 12% debenture at 100 each. Is it not needed to make
okay,
reserve?
good question. Fine. So now coming back to the point, it says that the interest and principal should have been paid on the due date. So here you can assume that the due date has not yet come. And since no information is given to you, you are assuming that the interest is also paid in time. So in all the questions that you are doing, it is an assumption that even though there is a loan in the balance sheets in the form of debentures or a bank loan, if no other information is given, you are assuming that the interest is paid on the due time, and it is not your purpose or your problem to pass an entry to for the redemption. Okay, you are just concerned about making the shares into fully paid and then doing the entries and then preparing the balance sheet. That's all. Doing the bonus shares and preparing the balance sheet. Yes.
Okay, ma'am. I have one more doubt. In illustration 5 on pay, that is regarding to cash cash ledger, we have to prepare. Okay. Separate cash ledger. Okay. Then what is the ultimate effect for calls in arrears? There is no effect in cash book, and also not journal entry is to be passed for that, no? Calls in arrears.
No, that will not come into your cash book because you are not receiving the amount itself, no?
Okay. And but journal entry we should pass or not?
Journal entry you will pass. In the account, cash account, you will not take calls in arrears.
But in module, we don't have any calls in arrears entry, ma'am.
Which module you're asking? You're asking about this concept or unit 2?
No, previous unit.
Previous unit mein, your doubt is in the cash account, why calls in arrears is not coming, right?
Yes.
Because in the cash account, how calls in arrears will come? Calls in arrears means you have not received the money. That is why you are taking it into calls in arrears. If you receive money only, it will come into the cash account. So it is mutually exclusive. Either I can have the cash or bank account, or I will have calls in arrears. So even though in the journal entry you are passing bank account debit, calls in arrears account debit, I got your doubt, okay? Even though in the journal entry you are asking bank account debit, calls in arrears account debit, it means that in the bank account you will not write about calls in arrears. Only the amount straight to the bank account you are going to write.
Yes,
Okay?
yes. But journal entries, besides that, we have to pass journal entries also.
Correct.
Transfer entry and that. But
when you are transferring the entry, no, you listen to me. When you are transferring the entry, for example, let us tell you are having one particular entry, let us say bank account debit 500, calls in arrears account debit 100, okay, to share allotment 600. Okay, this is your doubt. Now coming, when I'm posting it, I will show you simply. See, when I am opening my bank account here, okay, what I will be writing, I have a bank account to share allotment. So bank account gets debited. I write to share allotment 500. Clear? This will come in the bank account. In calls in arrears account, what happens? It is a loss for me. That is also debited. In calls in arrears, again I will write to share allotment 100. That is the amount of calls in arrears. Now when I go to share allotment, share allotment gets credited, right? So I will be writing here, there are two things here, compound entry. So in the share allotment on the credit side, bank account I will write, and by calls in arrears account I will write in the share allotment. So it will be 500 and 100, total will be 600. This is how I am going to post my entries. Are you getting it?
Okay, ma'am. Okay.
This calls and arrears will not come in bank and all. This and this mutually exclusive. In share allotment only you will get this on the credit side. That's all.
Okay. Okay.
Yeah. That's all your doubts?
Okay. Thank you, ma'am.
Okay. Okay. Thanks. The others? Kavita, Gauri, both of you are the same person?
No,
Gauri?
ma'am. No, ma'am. Kavita is
Different? You are different?
Ma'am, I have
Okay. Yes, please tell me.
ma'am.
Yeah.
Treatment of discount or loss on issue of debentures, ma'am.
Okay.
Illustration number 12.
Okay. Tell me.
I'm not understanding that question.
Because in the illustration number 12, you understood illustration number 11?
11 I got, ma'am.
What is that? What you got? The understanding is if the debentures are repaid after a particular period. So say, let us say after 5 years, correct? So what did you do?
Yes.
Total loss you have taken, divide by 5, over question, correct?
Yes, ma'am.
Yes or no? But in the next question illustration, you read the question first. When you read what they are saying, the debentures are redeemable every year. How much? How much is the portion they are redeemable every year?
I'm not getting, ma'am. That.
Did you read the question first of all? I will just a minute. Give me. I'll open that question and come back.
1 by 5/5, ma'am.
1/5 is redeemed, right? 1/5 of what is redeemed should be your point, correct? 2 lakh debentures into 10. So what is the total value you have in the hand debentures, which is outstanding at the beginning of the year? 20 lakhs, right? In 20 lakhs into 1/5 is redeemed. That means what? 20 lakh into 1 by 5 gives me how much? 4 lakh rupees. The meaning is, Gauri, every year I am going to repay 4 lakhs, 4 lakhs, 4 lakhs. Like that. In 5 years, I am going to repay 4 lakhs each year. 5 into 4, 20 lakhs I am going to repay. So the difference between my illustration 11 and illustration 12 is there in the tabular column, if you see, it will remain the same throughout. But in illustration 12, 4 lakhs will keep getting subtracted every year. So first year end 20 lakhs will be there. In the year end, I am giving back 4 lakhs. So next year, May I will have 16 lakhs. Then I am again giving 4 lakhs. So like that, each year after the repayment of 4 lakhs, why madam 4 lakhs? 1/5 you only told me, no? So that is why every year the same amount of 4 lakhs will come. So your debentures gets reduced. You should work out the ratio based on the outstanding debenture value. In illustration 11, it was same. It was 1 crore, 1 crore, 1 crore, 1 crore. So 1 by 5, 1 by 5, 1 by 5, same you did that. But When you come to the illustration number 12, there is a reduction. So whenever there is a reduction, you cannot directly do by 5 or by 6. You should do the ratio calculation. Why are you doing the ratio calculation? Because the entire debenture value is not repaid in one installment at the end. Every year some portion is repaid. So your debentures are reducing. When the debentures are reducing, you are supposed to work out the ratio. Okay?
Yes, ma'am.
So one thing what
And
I
ma'am,
would
ratio.
suggest. How did I compute the ratio? What
Yes,
is your
ma'am.
doubt? So 20 lakhs becomes 16, then it becomes 12, then it becomes 8, then it becomes 4. Correct? For easy understanding, I just removed the zeros. 4, 8, 12, 16, 20, everything is divisible by the tables 4. Correct? 4 tables. So 1, 2, 3, 4, 5. So I've just divided and found out a common factor.
Okay, ma'am. Thank you. Now I got, ma'am.
Okay, thank you. Now Del.
Ma'am, your teaching is very interesting, ma'am.
Sorry?
Your teaching is very interesting, ma'am.
Thank you.
Fantastic.
Thank you. Now, Del. What's your name? First.
Hello, ma'am. Good afternoon, ma'am.
Good afternoon. What's your name? It's written
My
Del
name
there.
is Muskan.
Muskan. Okay, Muskan. Tell me. What's your doubt?
Ma'am, how can we compute the ratio?
Of whatever I told right now.
Yes. But ma'am, in this question, it is very simple because it's divisible by 4.
Be very positive. No, they'll give you such easy questions only. There will be one common factor wherever you do divisible by 4 or 5 or 6. Anything will be there. So you don't have to worry. Okay?
Okay, ma'am. Thank you.
People are like worrying too much. Whatever is done in the class is very easy. This is what will come in the exam also. Be very positive, okay? So the others, anybody else, you people have a doubt? Or shall we close the class? Okay, Shoyab, thank you. Yes, thank you everybody. We'll be meeting for the next session, the unit number 5. Yeah, we finished 4, unit number 5. And let's do everything. But before that, kindly practice everybody. Only if you practice, you'll be able to do well in your exams, right? Bye. Okay, Kavita has one more doubt. Yeah, Kavita? I'm taking this last doubt and we'll close. Yes.
Madam,
Yeah.
I want to ask you that what is the presentation we have to show in examination? Means,
For these
if
units,
we
huh?
are- Yes, means
No,
if
you
we
can
are
you
asking
talk in
for
Hindi
general
also, no problem. I can answer, yeah. So
okay.
the point is the presentation point from the perspective, if you see, these are all the journal entries that you're passing, right? So for
Yes.
the journal entries, I've already told you several times in the class. I'll repeat it once again. In the books of the company, journal entries, put the columns properly, date, particulars, ledger folio, amount, and then you are going to pass the entries with the narrations. If dates are given, mention the dates. This is one set. Okay. If they're asking you to prepare the balance sheet extract like we were doing for the bonus issue, you should go to the next step and write balance sheet asset after the bonus issue. Write the headings that we were doing it here and then show the notes to accounts. Note 1, note 2, go to the working notes and do the workings. This is how you have to show it. That's all. Maximum apart from this, there'll be nothing else. Okay.
Okay, ma'am.
Yeah. Thank you. Thank you, everybody. And yeah, Hemlata, for your doubt, I will come back. Okay. The next time, I'll try to take your doubt and solve it. The previous year question papers, probably we will do it in the last session before I wind up, depending upon the time that I have. I will then teach you. Is that okay? Thank you. Bye.